Hey guys, welcome back to another episode of Shifting Gears. My name is Grayson Harris. We got Henry Byers over here. It's been a while since we talked to you guys. The last time, I guess, was just shortly before the port strike. It was probably a bit more short-lived than a lot of us would have anticipated. So we're basically here now to, summarize a little bit of what happened there, a little bit more of what we've seen from the market as a result of some of that stuff, and also some things that, maybe didn't pan out the way we would have thought it would. The market is acting a little strange, a little different than maybe we would have thought. So Henry's here to explain a lot of that. So without further ado, I'll turn it over to Henry. Henry, what's some of the things you're seeing in the market, man?
Yeah, we just had the opportunity in my mind to see, really as much potential volatility as may present itself currently. There is an election still coming up, so let's keep that in mind. Last election year got a little crazy, so there's always that black swan event that could occur. But essentially two hurricanes striking, no pun intended, with a port strike, really opened our eyes to just how oversupplied the market still seems. I think when you look at spot rates, this is dry van spot rates including fuel. I've really taken, the past years off. We're just looking at the last 2 years because I think we're entering, a state where, carriers may not exit on the scale that we had anticipated. And I think, that may stabilize rates more than many had hoped. And certainly if carriers had bled out of the market at a more rapid pace than, the current or recent events would have, dictated as far as spot rates increasing. We're basically neck and neck with last year, and still got a ways to go when you're looking at 2 years ago. But I think when you look on a line haul basis, we are positive year over year. So fuel's been putting, some pretty serious downwards pressure on rates too. So that's important to keep in mind. But even still, really flat when you're looking at over a year. And really, JB Hunt said a return to normal seasonality. At this point, I think you have to agree that that's really what we're seeing play out.
Right. So now that we're entering what is, essentially a normal holiday, peak season and everything, what are some of the things that you're looking forward to as we kind of get, closer to the holidays?
Well, you see line haul. If we just basically drew the exact same line and put it at the same scale that we have over last year, you're going to see it'd be really bizarre. We've been surprised many times in this market for rates not to increase some. I think, this is the strongest part of the year for trucking here at the end of the year, Thanksgiving, followed by Christmas and then New Year's. So you'd expect to see a very similar pattern. This is really strong seasonality. Labor Day was really disappointing, but I think, where you're not showing up for Labor Day as a consumer, you're showing up for Christmas and Thanksgiving. So I think, if you were holding out as a consumer, you're certainly gonna show up at this point in the year. So I think, we'd have all reason to believe that we may fit somewhere in between those two lines. And I think that's what I really mean by the return to normal seasonality.
Yeah. So overall then, is that a good thing, you would say? I guess it depends on what angle that you would, approach that from. Maybe I should be more specific, but, is this a good thing for the overall just general economy?
Well, I think we'll talk a little bit about just the macro economy, but I would say it's certainly indicative of not a very weak economy. I think at this point you would start to see, we've been talking about that next truckload cycle, right? It typically happens once you see the bottom. It's typically a couple of years until you see the top. So 2025 will be really the period where most people will be expecting to see kind of that next truckload cycle peak. Right. But we're seeing this, there's been a couple of head fakes this year, but overall it's been a very slow upcycle. So this may just end up being, just a very slow and gradual climb to the next peak. But this thing is certainly indicative of just how weak the economy is from interest rates being elevated has hurt a lot of investments that maybe would have happened had they not been so high. Right. And now the Fed's starting to cut rates. You start to get in this weird mix where companies may wait for more cuts. So when the Fed starts to cut rates, that's what people really think about is what's the likelihood they're going to cut again? Because if the economic data is showing such weak figures, then you would almost expect them to cut again if they're willing to cut once. And so that doesn't, bode well for things like inflation either, because now people aren't super convinced that inflation's under control. I don't think that people think that the rate cut was necessarily warranted in a sense just because those prices haven't come down. So, not only things more expensive, companies aren't as willing to spend because obviously their interest rates. You look at the housing market; it's certainly been very tough as far as mortgages and things like that, and anything floating in like the prime rate realm. So all things considered, I think it's just indicative of a really weak economy at this point.
So what are some of the ways that shippers are reacting to some of this? Are they kind of changing up their strategies at all? Is there any change to the contract rates that you've seen? What are some of the things you're looking at?
Well, I mean, from the shipper side, rejections is a great, indicator, right? I mean, you're looking at basically how much of my freight is, on average nationally getting rejected. Obviously, some places are tighter than others. When you look at this white line here, you've certainly seen things react to those hurricanes. You've seen the market, from a rejection perspective, the rejections have obviously gotten higher. I'm hesitant to say it's gotten much tighter because spot rates haven't really, this has been a departure. Mm-hmm. Rejections have gone up, spot rates have stayed relatively flat. So it's there's been a impact on capacity in terms of, where carriers are wanting to go, but it hasn't really disrupted the market in terms of spot rates increasing. Like we would have seen if the economy was perhaps a little bit stronger. Mm-hmm. And I think that coupled with where volume's at is a good data point to reflect on, why rejections haven't necessarily gone much higher and why that hurricane just, had a small impact. I mean, you're just looking at volumes that are now, pretty flat with the past 2 years. And again, if we're thinking about normal seasonality, which is just basically taking that white line and almost drawing it in between or right at, that blue line, which is last year. Right. Nothing from the demand side that's really putting a lot of pressure on that either. But when you talk about contracts, one thing that's interesting to note is now you're starting to see, so everybody's really thinking about year-over-year changes. When you think about a lot of data points, you're wanting to see year-over-year because once you start to see positive year-over-year, that starts to reflect like an upward momentum, right?
Right.
Now you're getting to a point where spot rates are basically flat. Contract rates.
Right.
So you're starting to see them stabilize. And so that's also kind of a sign of this next upcycle because you're really looking at contract rates versus spot rates. Spot rates, again, slow upward trend. Contract rates will follow. They're always, the one to lag. Obviously, as spot rates increase, they'll sign the next contracts a little bit higher and vice versa. So from a shipper's perspective, it's been a lot better from a cost perspective than it was the previous couple of years during COVID.
Sure.
But I think that the risk still to shippers is volatility moving forward,
right? Because
you're going to start to see routing guides get a lot tougher. You've seen a lot of short haul moves. You've seen a lot of private fleets pick up more volume, and all those things are things that pieces of the truckload market that you see pick up during easy times, you could say. But when times get more difficult, that's really what I think we're looking at here. We started to see contract rates increase a bit, and I think that's a lot of shippers are thinking about, moving those up quicker before they all of a sudden spot rates increase and they get, they basically have a really challenging routing guide. They're getting rejections. They'd almost rather move those up, and they're armed with better data than ever. So it seems like from a shipper's perspective, the spread between contract and spot still pretty high. But again, you're seeing it kind of slowly close that gap. And I think by the end of next year, those will be you'll be a lot closer. That spread will be a lot smaller.
That's a wild graph.
Yeah, for sure.
Like just the stark contrast.
Well, it shows you spot rates went so incredibly high. I mean, it just shows you. Yeah. Spot rates go high, contract rates reflect. So it doesn't really. You have to keep that in mind that they're always adjusting.
Right.
Contracts always the lagging indicator, but absolutely. So I don't think you would see contract rates have any significant movement upwards if this didn't close, another 25, 30 cents.
Well, what's then normal? Is this like in the actual baseline that we're talking about here? Has it ever actually consistently been there for a long time?
Well, there's always a spread, right? I mean, it seems like there's always, but you did see, I mean, even it's like routing guides couldn't adjust fast enough.
Sure.
But then you saw when the market actually, spot rates started to collapse, that spread got enormously wide. I'd say if you went back really where we were coming into 2020, if you take, let's say 25 cents would be a more balanced
that's what I was thinking. It's like I'm wondering if it's just not quite zero, but there's just a baseline that's closer to that 25 that you're talking about.
Yep. Yeah, I would say typically you would almost always see a majority of the year being slightly negative. But it just kind of depends on how rapidly things change.
Sure. No, that makes sense. How are carriers reacting to all this? How are they faring during all this?
Well, when you're looking at net revocations, you're basically looking at the amount of trucking authorities getting revoked. That pace has certainly slowed. And then if you looked at just the net changes, which is that same number, basically with how many trucking authorities are added.
Right.
And I think, look at what's happened since really the bottom 2023. Again, so spot rates, so everybody's anticipating this next truckload upcycle, and it's not happening as fast as people, may have wanted or expected. And it's because this rate of, capacity, the rate at which capacity is exiting the market has not been like the rate at which it was added. There's still a lot of carriers out there. I think that the SP, you go back to that Small Business Administration loans, I think carriers have remained solvent. Perhaps, they've had the ability to remain solvent more so than ever before with a lot of those loans. Again, the 30 years fixed rates, the rates were fixed at like 3.25%, has really helped carriers stay in business. And obviously, it's not that we want carriers to go out of business. It's just a natural kind of reckoning in the truckload cycle, right? Everybody's really anticipated it getting better, and so you've had new entrants into the market, and you just haven't. It's just been kind of this battle for the last few months of it being positive versus negative. Sometimes people, it's a little bit more pessimistic, a little more optimistic, and you're kind of seeing the seasonality play out even in that the net revocation or the net changes in trucking authorities, which is interesting.
Well, I remember a month or so ago, maybe a couple months ago, we were seeing record imports and things out on the ocean that were just crazy, that would make us think that there would be a little bit more change to the market, a little more volatility. It didn't quite happen, but it takes me back, though. What's happening to the ocean now? Is that still happening or slow down? What are we looking at now?
Well, let's go back to the hurricanes and the port strike. You have this incredible level of imports. So it really felt like if it was positioned to have volatility, it would have happened, and just did not see that volatility. That just lets you know how many carriers are still out there. But it also speaks to the inventory levels. Inventory levels, largely, shippers have largely been, if you look at wholesalers, upstream and downstream, a little bit thinner on the downstream side, but inventories are here. And if they're not here yet in terms of like in actual storage, that they're getting there. There's just not this urgency around it. Again, you have consumer demand kind of tapering off a bit, expectations. This weakness, you can feel the weakness in the economy. It just, no one's really optimistic right now. It's an election year for sure, but it's like, where is this tailwind going to come from? And from the import side, it doesn't really bode well for the next 6 months. But let's just say there's a new round of tariffs. There's a lot of things that could push import levels up. But as far as just consumer demand, I don't think it's going to be carrying us from here. But also keep in mind that it's about 3 to 4%, compound annual growth rate when you look at just general overall U.S. containerized imports. So that said, I think it's just a return to normal seasonality is what it looks like to me, barring some administrative changes and some new legislation that potentially impacts how shippers perceive the need to bring more inventory in. So shippers' cost pressure is coming down. You saw Golden Week here, rates dropped off. In some cases, like to the East Coast, to the tune of $3,000 in the spot market, bounced just a little bit, and then obviously have come back down. I think this rate pressure, down as far as it's negative rate pressure on ocean carriers in the spot market, it's gonna be hard for them to maintain these levels. I would expect to see these settle somewhere in this range. It's bad as it sounds. It seems like almost like a return to a more normal frequency. It's interesting to think back to 2024. I think we may see a very similar pattern play out for 2025. There's going to be some differences, but again, it all really depends on how demand is impacted, and it may not necessarily be just consumer demand that pushes the import volumes higher. I think we'd be very reluctant to say that if Trump gets elected that there wouldn't be some element of changes to how much volume needs to be shipped, because he's been very vocal about things like tariffs.
I was reading a story the other day. I think it might have been on FreightWaves. I don't remember exactly, but basically the rails on the West Coast were boasting about just how well they were able to handle all the volume. So we kind of had mentioned like, well, maybe they're just doing a better job. Well, they certainly seem to think so. Is that something that may have affected what we're looking at now?
No doubt. I mean, historically, we would have said that the rails are just really well positioned to service fail some of this freight. I think it did happen. It didn't happen enough, right. Versus how many truckload carriers are out there. So I mean, just look at this chart. It's just insane. The amount of containerized volume that's moving out of Los Angeles. So I mean, we're saying the volume's going to go somewhere. We expected more to go in the truckload market. So this was, we expected to see volumes come, go into one of these charts, whether it was truckload or whether it was, I just thought there would have been more truckload, to be honest with you. I just think the time, it speaks to when we talked about the urgency a lot, the economy hasn't gotten any more optimistic. It seems like, consumers have gotten more pessimistic as time goes on. It's just, everything's building up to this election in hopes that something, quote unquote changes. But, I think that he's really played into a lot of this, reluctancy to move from the rail to truckload. Yeah. Because obviously they're paying a ton for this to come up from overseas. They're paying really, incredibly high ocean container rates. They didn't really want to put that in truckload if they didn't have to. But it just speaks to inventory levels too, which is what I have next. Right. And you're seeing kind of this basically 60. If you drew, an average across all those years, you probably would come up somewhere in the range of that 60 level. Right. So it just speaks to, the Logistics Manager Index measuring, is a survey, where shippers, talk about, how robust your inventory levels. And obviously anything above 50 is expansion. We were below 50 when we were talking about the import boom, but now it's like our inventories are, rebuilt like we were talking about and perhaps rebuilding slightly more. So we may see another positive. But I think they'll stay above 50, for the next, 6 months or so. We talk about the Federal Reserve and interest rates. And this is what we're talking about. So we're talking about, how that affects the availability of credit. And I have here in orange, the other chart on the left, y-axis is representing the Institute of Supply Chain Management Purchasing Managers Index. If you look over there on the left y-axis, anything below 50, much like the last chart, is in contraction. And we've been below 50 for a few different data points. And actually, if we went forward, this hasn't updated, but the last two were also below 50. So it speaks to what happens when interest rates are low. You see very robust, increase in orders, increase in manufacturing. So this is that part of the economy that is not helping the truckload sector at all. Why is that? And I think because you think about all these things that go into. It's not just imports. It's imports, are then put into, and oftentimes, even though it comes from overseas, a majority of it manufactured, assembled here. There's a lot that goes into servicing those assembly plants. Then there's also just manufacturing. Domestic manufacturing, has been weak. And so when you see all that aggregated together, that's really what this is. That's why it's such a good proxy for the economy's at. And you've seen interest rates essentially take that negative. There's companies that are just unwilling to invest, build new plants, without interest rates coming down. And now that they know that there's a likelihood they may come down further, they're going to wait until, that time is right. They kind of hedge their bets, for the Fed lowering rates even more. And interestingly enough, like things like flatbed outbound tender rejection, which are closely tied to those manufacturing cycles, obviously rejections would go up the more demand as there is for flatbeds. We use it as a proxy to try to gauge that. They've been incredibly weak. The flatbed market looks like it's well positioned to be, relatively flat and stable, into 2025 as well. Right. And I think a lot of it rides on what happens here with inflation, and then, what a new administration's capable of doing, for the economy. And so when you look at spot rates for dry van, and you look at it including fuel, and we think about what's optimistic, what's perhaps mid-range, and then we talk about kind of a pessimistic view for spot rates. I think these two lines represent our perspective in terms of like where could we play out these ranges. So in the best case scenario, I think we end up somewhere between this teal line and this upper green line, somewhere between that 237 and 251. And then I think, pessimistic view would be just hover somewhere right around this range. I don't think spot rates will go much lower, if at all. I just think the market is just showing the slow upward trend. So I think it tends to not go much lower than a certain point. It's almost like how stocks trade. You see how even the low, there was only one time this year where it reached even lower than the other low points.
Yep.
It's interesting how that works. But it's dynamic, and it's certainly in the way brokerages work. The thing is, it's a pretty efficient market in that sense. So I think I think we'll stay somewhere right around this red line for the next week or two. Perhaps get a little bit higher around 230 during the peak, maybe just a tad higher. But I think next year is really what we're pointing out here in terms of where we could end up in Q3, Q4 of 2025. Gotcha. So I think that's the optimistic view, and I think that we're more likely to end up there. I think there's going to be some momentum come from somewhere. We'll just have to wait and see. But I think the normal seasonality, I think, will certainly apply more so than it has to years past.
Yeah.
I think kind of this, really being able to, predict what months are going to be a little bit higher than others. Because again, I think a new administration kind of start to figure out where we're going to be for the next couple of years. And so things start to get figured out. People start to pull the trigger where they may have been waiting. So it'll be interesting to see.
Well, as we sort of, wind down the year a little bit, now we're fully into the swing of things into Q4. What are some things that, shippers and people in the logistics industry need to sort of be aware of and look forward to as we round out the year? And we'll come back, I think one of our next episodes will be more related to forecasting what we might see in Q1 of 2025, Q2, just kind of things to look forward to. But until we get to next year, what are some things that you got a keen eye on in terms of how we're going to end the year? Yeah,
I think what the Federal Reserve, chooses to do will be one of the most impactful things. I think the new administration as well. I think what happens geopolitically, around the world, there's still some things to watch out for there, the Red Sea.
Yeah.
But I think also, one thing to just, keep in mind is what we were talking about with the contract rates. I think, trying to really get a grasp on and stay updated on, you're always trying to use these current data points to try and assess where we're going to be in the future. You never really know. There's surprises. I mean, we've been surprised 3-4 times this year already. Even though certain data points in the past would have reflected a certain, outcome. Right. I think it just speaks to being nimble, being able to adjust relatively quickly. And I think the contract rates being, relatively stable. I think, again, we're basically talking about this next upcycle. So the exposure is definitely to the rates going up still. So when you're looking at your routing guides, you need to be aware of where spot rates are trending. Because if there was, an incredibly cold winter, if there was a big disruptive event here domestically or around the world that impacted the U.S. or supply chains, these things can change quickly. So I think just being in tune with where you're at in that cycle and being able to have a plan together for any of these events that may come up.
Well, guys, we'll be, like Henry said, we'll be keeping an eye on things to see how the year ends. If you want to stay updated on everything that's going on in the truckload market, or if you're a shipper out there, or if you just need some help, you need a quote to kind of, figure out how do I protect my supply chain? How do I get it ready for next year? We have all that information down in the description. We got our website down there, all different social media channels. So feel free to go check that out. In the meantime, guys, we'll be back next time with a sort of outlook for next year. We'll kind of forecast it a little bit and have some fun with it, make some predictions. But in the meantime, until then, we'll see you guys, and thank you for joining us. Bye.
Thanks.